One part, not your average investor show, Tuesday afternoon here with Gregg Cohen and Pablo Gonzalez. Welcome, everybody. I am Pablo Gonzalez, the host of the show. With me, as always, the guy that they call GC, the guy that generates cash flow, the guy with the genius concepts, the guy who is a great co-host, and his name also happens to be Gregg Cohen. Welcome, Greg.
Thank you, buddy. Thank you, everybody, for being here. I hope you guys are fired up, and I'm certainly fired up to be with you here today.
I'm fired up too, man. You know, we're talking before going live here on Facebook that there's a lot of misconceptions on what real estate cycles entail, where we're at, what, you know, how you should be judging things. And as a person who plays a real estate commentator on TV, I am now officially, I've been getting into more and more real estate conversations. Like I'll give you an example. In Spike Ball this weekend or last weekend, one of our friends that plays there is a realtor, and somebody was asking about where we're at and this and that, and he was speaking, and I'm like, that doesn't, you know, like I don't think this dude's talking months of inventory, and I don't think he's you know, like the stuff that they were saying. I was like, man, I really, you know, I jumped in and I kind of reframed it, and I just find it really interesting that people that this is their profession haven't really looked at it through the lens that you look at it, because you have all these data points, that you've lived it now for 14 years. You've served all these clients. You've seen it so many times. So I'm really, really excited to get into this, man. So
yeah, you know, and it's almost like, you know, people think that real estate is this, it's almost like, you know, timing the market is something that you hear a lot. I got to time the market. You hear that a lot in the stock market. I got to time the market. In real estate, there's actual data. There's actual metrics that allow you to kind of see where things are going. And it's not 100% perfect, but it really is strongly correlated. Whereas in other investments, we'll talk about the stock market, very emotional. We've seen that this year. We've seen huge rises and huge falls, and not exactly tied to data. So there's this huge opportunity in real estate to understand what these metrics are. And guys, I'm going to share them with you today. It's not rocket science. I mean, even I can do it. And when you just kind of have these, you know, points to look at, you're at least going to be armed with better information than 99% of other real estate professionals out there. And you're going to be able to take this into your own market or with your investments here in Jacksonville with JWB. And you're going to understand why we're saying what we're saying, why we're doing what we're doing. You know, why is JWB going to buy more houses this year than we ever have before? I'm going to walk you through the data that we see. And, you know, it's guided us to this point so far. And there's such a strong correlation that it is very different. It takes away some of this kind of ambiguity about how do we know where we're going. Well, guys, I'm going to show you, and you just got to master a few data points.
Yeah, cool. I like how you said it, armed with information. That's how I felt in that conversation this weekend, because it was like one person that was uneducated asking another person that was supposed to be educated on real estate. And based on the way that they answered it, I felt armed with information to be like, oh, okay, so this is how you're looking at it. Like, what about this? So pretty interesting. Lee Bishop writes in the chat here, Greg, you underestimate yourself, my friend. And I'm going to just piggyback on that and say, not just that, but you can't take the title of the non-expert here, bro. You are the expert. I'm the non-expert. Don't be mowing my lawn over here, my friend. Let's get into it, Greg. So you said, first of all, we're going to understand what a real estate cycle is. Like, and I understand, I think people tend to confuse the correlation between a stock market cycle and a real estate cycle and what differentiates those two things. Can you talk me just kind of like high level what you were talking about? What is the difference between the real estate cycle and the stock market cycle?
Yeah. So let's understand what a real estate cycle is versus a stock market cycle. When we hear a cycle, we tend to think that means that things are going to go way up, and then things are going to come way down, and then things are going to go way up and down and up and down. We tend to think that prices are going to appreciate, whether that's stock prices or real estate prices. And then we think on the other end, prices are going to depreciate. Things are going to go down in value. That's typically what a cycle is thought to be, but it's not the same thing when it comes to the stock market versus when it comes to real estate. There's a lot of data to support this. I'm sure we'll show some of the graphs here in a little bit. But basically in the stock market, you have huge swings. If we go back to coronavirus hit, the market went down 26% in 4 trading days. That's real volatility. That is real depreciation of the stock market. And then you saw it roar back up, and it has gone back up. That's an upswing. It doesn't really happen that way in real estate. So in real estate, prices, it's not whether or not things appreciate or depreciate. Over time, it is extremely rare for prices to depreciate. In real estate, what you're really looking at is, am I going to see a higher than normal home price appreciation level, or am I going to see a lower than normal home price appreciation level? Big difference. That's one of the reasons why I love investing in real estate, is because it's a much more consistent asset class. Your level of volatility is much smaller. Your range of volatility is much smaller. And if you're like me, and like a lot of our clients, that at the end of the day, that helps you sleep better at night. Now, for those who are investing in 2008, you're going to say, well, Greg, it didn't exactly work that way in 2008, and you're 100%. But what I want you to see is over time that is the anomaly. And now we have a lot of recency bias when it comes to the market, because many of us were investing in 2008, myself included. We saw the market dropped. The market actually dropped about 35% in Jacksonville from 2008 to 2011. So I know what a market drop feels like. And then after that, what we've seen is higher than normal home price appreciation since then. So a lot of people are saying, oh man, higher than normal home price appreciation for the last, call it 10 years, we have to be at the peak again. And we have to be experiencing another drop and a depreciation of values. And that would be incredibly abnormal. The reason it happened in 2008 was largely due to the lending practices that we had. And there's a number of other factors that we'll kind of talk about here. But Pablo, why don't we show them some of the data behind this in the graph there to show them what housing prices have done. I believe it's since 1963.
Yeah. So, speaking to our friend that's listening on the podcast now, we see this low line down here in 1963, and it just steadily creeps up, takes a tiny little dip in around 1990, keeps on steadily climbing in, I don't know, that looks like 2003-ish, maybe a small dip. And then there is this one big dip that we're all very, very familiar, which was the market crisis. That looks like it ran from around 2008 till maybe regaining equilibrium somewhere around 2012, 2013. And then since then, it seems to be back on a very similar trajectory of a low rising slope since then.
Yeah, absolutely. So, I mean, what you're seeing here is absent of one anomaly, which was the Great Recession, which was caused by real estate. Generally speaking, you don't see market volatility show decreasing in a decrease in housing prices for at least an extended period of time. If we were going to put the graph up of the stock market, that probably would have been a good thing. If we could put that stock market graph up, you're going to see way up, way down, ups and downs. You're going to see huge rises, and you're going to see big drops in value. So the reality here is that a market cycle is usually about higher than normal home price appreciation or lower than normal home price appreciation. So when we're talking about what should be happening in where we are in this phase of our market cycle, we should really be talking in terms of that. Higher than normal home price appreciation or lower than normal home price appreciation. It would be really unusual. There would have to be a lot of unusual circumstances that would have to come to play for us to get up here and say, you know what, we should see price declines. We should see price decreases. One of those outlying numbers would have to be a lot of supply on the market and limited demand as well. And that was one of the things that happened in 2008. And I know we're going to get into that here.
So before we get into the supply side, I also, you mentioned something on the emotional side too. Like I'm seeing this, like I've got this like investment in Peloton. I saw the CEO come out and talk about how they had the biggest quarter they've ever had. They had their biggest sales they've ever had. And yet the stock dipped like 6%. Like it's because of investments into supply chain, like something along those lines. And there seems to be a very elusive formula for what drives up price of something. It seems to be very, very emotional. I don't get that sense in real estate, right? Like we talked about how the GameStop fiasco, for that to have happened around a neighborhood, it would have required all sorts of like colluding from property appraisers and public officials and all this other stuff. Do you want to talk a little bit about what protects the pricing of homes and before there can be any kind of emotional dip?
Yeah, well, it's supply and demand. It's supply and demand is what governs prices in real estate. And it's not that way in the stock market. There's an incredible amount of emotions. You can have your company that you're investing in do incredibly well, but because the expectations they gave to analysts were to do 1 cent better then all of a sudden they were below expectations, and now the stock's in a free fall. So, in real estate, it's one of the things that I love. Like, I don't have to play that emotional game where I have to understand, it's I don't have to understand emotions. In real estate, I just have to look at a few metrics here. We're going to look at supply and demand here in just a second. And after that, I have to pay attention to what's going on in the world. It's not the end all be all, but at least I have a strong leading indicator, a strong correlating factor there that in the stock market you just don't have.
All right, so let's talk about that supply and demand statistics. Let's put up some of this inventory data now. Is that what you want to get into, Greg?
Yeah, let's talk about it a little bit more, because before we look at the numbers, people can tend to get, focused on the numbers here. So if we're trying to figure out if we're in a higher than normal or lower than normal home price appreciation arena, the number one metric to pay attention to is months of inventory. Months of inventory is this wonderful metric that puts it in front of your face as to what the supply and what the demand is doing now. So what months of inventory tracks is the number of homes that are on the market, and it divides it by the number of homes that sold last month. And you can do this in your market. We do this in Jacksonville. We've been tracking this since 2014. And an equilibrium market is between 6 to 7 months of inventory. And what an equilibrium market would indicate is that you would see normal home price appreciation for your MSA, your metropolitan statistical area. That's basically Jacksonville. And so if you're between 6 to 7 months of inventory and you know what your historical home price appreciation rate is, then you kind of have some bearings here. And you're saying, okay, well, if I'm 6 to 7 in Jacksonville, the historical home price appreciation rate is actually 4.3% per year on average, is what we have done since 1991. So that's what we look at. And if we are above 7 months of inventory, that would indicate that there is a buyer's market. That would indicate that there's more inventory, more supply on the market, and there's not enough sales to exhaust it in the next 6 to 7 months. And so you would see downward pressure on the appreciation rate. You would expect it to appreciate at a rate that's lower than 4.3%. And if you get to 10 months of inventory or even higher than that, then you would expect more pressure as prices would appreciate at a slower rate. If you get all the way to where we were in the Great Recession, in 2007, our months of inventory was 18 months of inventory. That's one of those external factors that I was talking about that you would see a price decline. And that's what we saw when you got to 18 months of inventory. But we're nowhere near that now. We're actually a lot lower than 6. And so if you get to below 6, then you're put yourself in the shoes of a business owner. If you're a business owner and you've got limited inventory, limited number of things to sell, and things are selling really quickly, then you're going to see upward pressure on prices. And you would see pressure for prices to rise at a faster or higher than normal rate. So more than 4.3%. And as we look at what has happened, if you go back to the Great Recession and you see what months of inventory were prior to the crash, and then you've seen what months of inventory have been every month since then, it is really correlated to lower than normal home price appreciation and higher than normal home price appreciation. Like, for example, we started tracking months of inventory in 2014 here at JWB, and our months of inventory has been between 2 to maybe getting up to 5 months of inventory since 2014. And so that would indicate higher than normal home price appreciation. And guess what's happened since 2014? We've had higher than normal home price appreciation. So let's show some of the stats here. Let's show people really where we are as far as months of inventory now.
Yep, let's show it, man. So first of all, Greg, I wanna differentiate. Now we're talking about Jacksonville specific statistics.
We are.
Okay, so just because Raja Bantu asked in the chat, he asked, "Where are we in the Jacksonville real estate market cycle?" So I just wanted to frame it as this is specific to Jacksonville.
Yeah,
So
absolutely. All this data is specific to Jacksonville. Anybody can get this data for your own market. It's readily available.
okay, so again, to explain it for a friend that's listening in their ear now, January 2020 inventory on market, there was 7,559 homes, total sales of 2,686, and a total months of inventory of 2.81. So well below that 7-month mark that you had stated. And then as you fast forward to November and December, we get closer to about almost 5,000 homes on the market in November. In December, it's like about 4,400. Total sales of 3,200 in November. Total sales of 2,800 in December, and then months of inventory of 1.52 and 1.57. And now we get to January 2021, and it's 4,200 homes on the market. Sales seem to have ramped up since November, since December, or at least it dipped in December and came back for January at 3,267, and we're at a months of inventory of 1.31. Greg, so what does that mean?
Means that there is literally, I've never seen it this low. I've never seen supply this low. 1.3 months of inventory is shockingly low. And this is a result of what has actually happened from the Great Recession. In fact, I'm kind of pulling up. I want to give some more context. In fact, Pablo, can I share the screen a little bit here?
You man.
Let me share the screen here. Boom, boom, boom. Man, one thing. Boom. Man, I thought I was ready, but I'm not. Cool. Got it now. There we go. Share the screen.
Listen, Greg, while you're saying this, I might as well just take the opportunity to say I didn't give our
Can you guys see
usual
it now?
introduction. Yeah. I didn't give our usual introduction. This is an interactive show. We want you asking questions. The Q&A isn't working now very well. So if you can just use the chat, which I normally tell you not to do, but I am tracking it now because it's the only thing on my screen. Use the chat for any questions that you want in. And if you want a overall passive investing income guide, go to jwbpassiveguide.com. And that's where you can download the guide to passive income properties. And now, without further ado, continue on, Greg.
There we go. There we go. So I want to give you guys some context of what it really looks like to be in a market that was about to see price declines. This is from June 2006, 2007, 2008. We had 11,000 houses on the market in June 2006. And we had a month of inventory of 6. At that point, everybody's looking at this and saying, okay, no cause for concern in 2006. Prices were actually still going up. And so as we kept going on, though, we started to see more inventory on the market, and we started to see our sales number drop. This should have been a big warning sign for a lot of people that there was something that was about to happen. Check out where we were as we got into 2007. Now, 2007 is really the last time that we saw price increases prior to the Great Recession, and then they fell off a cliff. Well, it's not so surprising why they fell off a cliff when you're looking at 11 and 18 months of inventory back in 2007. Look at the number of houses that we had on the market. We had 16,000 houses on the market and only 905 sales in December of 2007. Now, why did this happen, Pablo? What were builders doing all the way through 2001 to 2006?
Oh, I was part of that boom. They were building tract homes like crazy. They couldn't buy enough land to put enough houses on it and put, these like pre-planned communities on that. They were just cranking out one after the other, and people were getting super easy mortgages to be able to buy them.
Exactly. They thought the music was never going to stop, and builders did what builders do, and they built as much as they possibly could, and they oversupplied the market. And the reason they did that is because anybody could get a loan at that time. And there was this artificial demand. When the music stopped, it really stopped for a lot of people. And what you're seeing there is when I'm saying the music stopped, demand dropped. And when demand dropped and we had 16,000 houses on the market, that's why the market fell 35%. Now, Pablo, if we could show people the numbers again, kind of where we are today, we You do not have anywhere near 16,000 houses on the market. In January of 2021, we have 4,266 houses on the market here in Jacksonville. That's incredibly low. And I wanted to show just what it was a year before. We had almost 7,600 houses 1 year ago on the market. So you dropped, almost in half as far as the amount of inventory. There is an extreme supply shortage. Now, the real estate market is, it's a market where it's largely driven by building. Supply is largely driven by builders. So when builders overbuilt and oversupplied through 2001 to 2006, and the market fell, what do you think builders did from 2010 to 2018, 19?
They shut it down, man.
Shut it down.
Yeah.
Nobody was building. And there's a stat from the National Association of Home Builders, and it shows how many houses we need to build to satisfy household formations. And we built about half the number of homes that we needed just to satisfy household formations in the 2010s. And so we went from both ends of the spectrum as builders in this country. We built way too much based on artificial demand prior to the Great Recession. And then after the Great Recession, we didn't build anything. And so what's happening now is a result of that. The inventory that you see on the market is way low, stemming from what happened post Great Recession. And now what you're seeing is that the demand has been really increasing, specifically in markets like Jacksonville, because of what coronavirus has done, what COVID has done. COVID has accelerated a lot of what was already going to happen. And in Jacksonville, people were already moving here. We already had huge population growth. Now it's on fire and people are moving here, and you're seeing people buy houses. And oh, by the way, interest rates have never been lower. So this high net migration and low interest rates is causing our sales number to spike. And that's what you're seeing here. Prior to, I think it was June of 2020, Jacksonville had never had 3,000 sales in a month. And then from June, pretty much through the rest of the year, December, we had 2,800 sales, which is typical. You typically have a lower number of sales in December. That was the only one, I think, that didn't have 3,000 sales. Just look, from January 2020 to January 2021, so you take the seasonality out of it, we had 600 more sales. Like, that's not normal for a market that only generates usually about 2,500 sales in a given month. So all of this great storm, this perfect storm is happening in real estate now. And that's what's causing severely low supply. That's what's causing severely low months of inventory. And that's what's going to cause higher than normal home price appreciation as we look into the near term.
Okay. So before we dig into what that means as a potential investor, Lee Bishop has a question here. He says, December 2020 was 4,413 and houses sold was 2,806. In January 2021, inventory was 4,266 and sales were 3,267. The number means that a lot of houses must have been built and sold in 1 month, or am I missing something in the number translation?
There's a lot of houses that were sold, not a lot of houses that were built. So builders now are trying to build everything that they can. So they look at this information too. And if you're a builder, you're looking at 1.3 months of inventory. You've been looking at this for the last year and seeing 2.8 months of inventory. And you're saying, let's build as much as we can. But they can't build enough to satisfy demand. So what you're seeing here is that a lot of existing homes on the market are getting depleted. There are new builds that are added to the market, but not at the rate that would be needed to satisfy the demand. You would need to build a ton more houses to get your months of inventory number to rise to be able to satisfy the 3,000 to 3,500 home sales. And you're just not seeing that. And there's one other thing to keep in mind about builders, especially in a market like Jacksonville. And this plays so well into the neighborhoods that we put our clients in and the neighborhoods that I invest in. A builder is not going to build something for free. And when you go and you try to build a house, it's almost impossible for a builder to actually make a profit and keep the purchase price for that home under $220,000 or so. So builders have been looking at low months of inventory. Remember, I shared with you that it's been between 2 to 5 since 2014. But builders have made the decision to not come into the neighborhoods that we invest in, the below middle income neighborhoods in Jacksonville. They've seen this data, but they said, I'm not going to build there. The reason is because prices in those neighborhoods have not risen enough to where they can actually make a profit and sell the property. So that's another reason why you're not seeing the number of builds jump up until, now everybody's trying to build. But that's the reason why you didn't see this problem getting solved 4 years ago, 5 years ago. It's because there was no profit in it for the builders. Prices must rise in these neighborhoods to a point where builders can make a profit, and then they can start to capitalize on low months of inventory.
Got it. Okay. So now we're seeing super low months of inventory. We're seeing that now it's low enough where builders are coming in. You said that we're going to see higher than average price appreciation in the near future. What does that mean for somebody looking at, is this the time to buy a rental income property? How does that benefit me? How does that hurt me? Like asking for a friend here. I just closed on my house 2 weeks ago, or 1 week ago. Like what should I expect as a new investor right now?
Yeah. Let me put some numbers behind it. So every year our team predicts what we expect housing prices to do over the following year. And we're pretty darn close, actually. We've done this, I think, 4 years in a row now, and we've been really close. We predicted 4 to 5% price increases last year. It was 6% here in Jacksonville. And this year, we're predicting 8 to 10% price increases in 2021 for Jacksonville. That's the highest we've ever predicted. And, coming strong with that, going the highest, 8 to 10% in a real estate market is double, 2.5 times what normal appreciation is. But when you're looking at what we see here, we just have a high degree of confidence that it's going to play out that way. So you guys can hold me accountable to that. It's on social now, it's recorded, so it's there for everybody to see. And it's here in February. And I think that you're going to see 8 to 10% home price appreciation here in Jacksonville. Now, if your prices go up 8 to 10%, Pablo, as a new rental property owner like you are, how does that make you feel?
I feel great now for the home I just bought. I feel like I need to go sell that Peloton stock for the next home I want to buy ASAP.
Yeah. It's a double-edged sword because a lot of our clients are just like you, Pablo, and just like you who are listening now. You probably have some rental properties in your portfolio, and you're probably looking and saying, hey, I might have another 3 or 5 or 10 to reach my passive income goal. Let's keep it broad here. Let's talk about what's happening in the overall kind of rental property market. Now, what you're going to see is that prices are going up across the country. Jacksonville are going up here, just like the data I showed you. The fact that there's low months of inventory is a nationwide issue. There's low supply in almost every market out there. So what you're going to see is that prices are going to go up. What you're also going to see is that eventually interest rates are not going to be this low. They must go up at some point in time. And I don't know if that's 6 months from now, a year from now, 2 years from now, or whatever. But that has to go. That has to go up. When you see prices rising and you see interest rates rising, what that should mean to you is that your cash flows are going to compress because your purchase price is going up and your interest rates mean that $250 a month or so in cash flow is going to become $200 or $150 or $100, depending on what market you're in. Many markets are going to be priced out of inventory. So this opportunity to invest in rental properties is not going to be the same opportunity. If you take it one step farther, Pablo, have you heard me talk about how other markets now, other turnkey providers, when you go and you try to buy properties from them, have you heard me talk about how they try to put you on a waiting list?
I am familiar with this talk. Yes, Greg.
Yeah. So think about that. They have a ton of people that want to buy rental properties now. I've never seen it like it is now. And them as a business, they cannot source enough inventory now to accept the money that a perfect client would be willing to give them, because they can't source the inventory. Because what's happening is that purchase prices are rising for them, and the cap rates, the cash flows are compressing to where they can't make the numbers work for their people, for their clients. And so if you put yourself in the shoes of a business owner, you never want to be in a place where you have people that want to give you business and you have to say, yeah, that sounds awesome. Let me get back to you in 6 months. Right? But that's really what's happening. That's a precursor for what's going to happen in this turnkey rental property space. Flat out, businesses just can't survive when they don't produce income. And if they don't have properties to sell, they are not going to be able to produce income, and they can't hold on for that long. A waiting list of 100 clients that want to buy a house from you does zero for the income that you need to generate to keep the lights on. So what you're going to see is across the market, a lot of these cash flow markets are not going to be producing positive cash flow. And what you're going to see is a lot of these turnkey providers who popped up over the last 2 years, 3 years, because it was fashionable, they're going to change their tune. They're probably still going to be in real estate, but they're going to become home flippers. They are not going to be providing cash flowing properties near the level that they are now, and maybe not at all. And so people really need to understand the opportunity that you have now to be able to buy rental properties is not the same opportunity you're going to have in terms of market, in terms of provider, and in terms of cash flows and returns if you look 3 years from now, 5 years from now, because the numbers just don't work that way. If you think about prices going up 8 to 10% this year, and you think about interest rates maybe going up to 5%, your cash flows they're going down. And that's just the reality.
Okay. So cash flows from here forward, your prediction is that home prices are going to go up, and cash flows for the properties you have available to you now are going to decrease nationwide, including Jacksonville as well. And that less prepared turnkey rental income property providers are going to be shutting some doors and or changing business models. What differentiates JWB? What differentiates Jacksonville in that equation?
I'm glad you asked that. So we are not concerned at all for JWB, for our clients. And it's because we really have, I think it starts with our commitment to Jacksonville, because we looked at this and said many years ago and said, well, do we want to open this up to other markets? Is that what we want to do? And we said, no, we want to be here in Jacksonville. Well, with that mindset, we knew that we needed to be many years ahead to be able to have a runway of inventory for our clients so that the numbers would work. And that's how we've operated for many years now. We want to have 2 to 3 years of a runway of properties for clients beyond what we're buying this year. And that's how we've operated. So for JWB, there's a couple of things that are really working in our advantage. We have no concerns about our ability to be able to provide positive cash flow properties to clients. We already have a runway because we bought all of this land beginning in 2011 when we started to acquire land and started to build out our new construction homes. So if those other marketplaces are not creating their own inventory, they're in a really tough spot. The providers out there who are putting people on waiting lists, generally all they offer are renovated homes. They don't have the ability to go out and buy land and then build new construction. And even if they want to start doing that now, guess what's happened to land prices and building costs?
Gone up.
They've gone way up. So even if they want to jump in the game now, unless you were doing this and buying a lot of land and sitting on it since 2011 like we have, you're not going to be able to source the demand, and you're not going to be able to make the numbers work like we can at JWB, to be able to make sure that we have positive cash flow while also ensuring that JWB can make a profit on it, and other turnkey providers just can't make the numbers work there.
Okay. So I'm curious about one thing. What does your calculation look at when you've been buying land? Like, are you guys looking at an ROI on that land 5 years in the future, 3 years in the future? When you guys started acquiring land in 2011, what stopped you from buying every plot of land in the zip codes that you knew worked?
Well, in 2011, it was the first year that we were doing it. So, I mean, and I got to share with you, nobody else in the country was buying land to build new construction houses to rent them out. So it was a new thing in 2011. Probably from 2011 to maybe 2015, capital is what restricted us. We needed to make sure that the capital that we had access to was able to be used, but within our capital structure, we probably bought as much as we possibly could in 2011 to 2015. Really, since then, we're not limited by capital. We're really blessed to have those capital lines available to us. And we have bought everything we can in our neighborhoods, those infill lots. When the price has been for us, we have bought as much as we can because this has been very clear that we would have this type of a moment as far as low months of inventory and lack of inventory for other providers out there. We felt like this was going to be our time to shine. And so we've been preparing for it for a long time.
So let me ask you a really difficult question. If this trend continues at the rate that you think it's going to happen, the pricing is going up, interest rates are going up. At what point is JWB selling rental income properties only for appraisal and not cash flow positive day one kind of thing? Like, at what point does that happen?
So I think what you're asking is, when would it be cash flow neutral and not cash flow positive, like at $250?
Correct.
I don't know. I think that could happen in future years. I mean, you got to look at the numbers here. If values go up 10% this year, and then your interest rates go up a point, and I don't have the numbers in front of me, but it's going to compress that 250 to something like $100 or something like that. So $100 a month. So, I think that that's very real. Your positive cash flow all along the game here, positive cash flow has been something, it's been a new profit center for rental properties. Like, for so many years and decades, people bought rental properties and just hoped that they would pay for themselves every single month. And then over time, real estate appreciates. So they bought and hold for a long time, for a full market cycle. You wanted to make sure that it paid for itself every single month. And then you're going to be able to be rewarded handsomely by holding on for a full market cycle, especially when you use leverage and you see that values go up over time. So that was the way that things happened. And that's the way that people invested. Then the Great Recession happened and prices decreased so much. Interest rates still held low. And now you, as a rental property investor, had this amazing opportunity to not just get those 4 normal profit centers, but you could actually add in a 5th one, which was positive cash flow. So you're going to see it return to that level again. And on one hand, we all may be saying, well, geez, that's not as great as what it is today. But every moment along the way, you should be comparing your decision as to invest in one asset class versus another. I always tell people, like, that additional $100 or $200 or $250 a month per property is not going to change your life. The reason that I think it's so important is because it allows this to become scalable. And when you count all 5 profit centers in rental property investing, and you compare that to what you could make in the stock market or in bonds or in some other asset class, even if you took that positive cash flow away, many people, myself included, are going to look at the 5 profit centers and think that that's a better value in rental property investing, even if you don't have that extra $100 a month or $250 a month. That's just where it's going.
That makes sense. So here's another tough question. Is this then the time to sell if you've been holding on to your property, even if it hasn't been a full cycle? And if not, why not?
Well, you know me, I'm a buy and hold guy, and I want to attract clients that believe in the buy and hold as well. It was interesting when I first asked you the question when we were just jumping on the call here. I said, I see prices going up. How does that make you feel? And you said, well, I think it's great because of the asset that you own. And I think it's great for the assets that you own to experience higher than normal home price appreciation as well. But honestly, it doesn't change the long-term strategy. It doesn't change how we make decisions as far as investing in rental properties just because you have a good appreciation year. This mentality is built on over a 10 to 20 year cycle. You're going to see the average historical home price appreciation be what it was since 1991. That's why it's called a cycle. It's not a cycle of, am I going to go way up in value or decrease in value? It's, am I going to have higher than normal home price appreciation, lower than normal home price appreciation? And if you look over 10, 15, or 20-year segments, you're probably going to be at that 4.3% appreciation or somewhere around there. So when it comes to having higher than normal home price appreciation for a year or 2 years or 3 years, does it change the mentality? I don't think so. Because what are you then going to take that money that you would sell that property and put it into? If you love the investment in Jacksonville, if you love the investment with JWB, you're then going to buy another property that is going to have lower cash flows than the one that you probably bought. Now, if you're thinking about another market and maybe you see another opportunity, maybe you see another asset class, maybe that makes sense. I can't say that doesn't make sense, but if you're just looking to replace this asset with another asset and be able to take money out of the one that you sort of made a short-term appreciation gain off of, doesn't really make a whole lot of sense. And then there's a lot more value for holding on to an asset long-term. Like, for example, your principal paydown goes up the longer you hold on to the asset. So the tenant pays more of your principal down for you in year 2 than they did in year 1 or in year 5 versus year 3. So the longer you hold on there, that's certainly going to benefit you. So I don't think it changes much. It definitely doesn't change the mentality investing in a market that is experiencing higher than normal home price appreciation or lower, because I know based on the data that after a 10, 15, 20-year segment, I'm going to look back and it's going to average back to roughly what the historical home price appreciation rate was.
What about if it's between, so first of all, when what you're saying makes sense to me. Like I hear higher than average home appreciation, and I think now is definitely not the time to buy. I want to experience that higher than average home price appreciation, not to sell. Like I want to experience that higher than average home price appreciation. But then the back end of that means that, let's say it is 8 to 10 for the next 2-3 years. That means that the 2-3 years after that should be 2 to 2.5 or whatever. Like if it's going to average out to 4.3 at some point. So, and then when I think, what else would you put it in? I would say, well, if I can put it in private lending, that gives me 10%, while, if I can cash out at the peak of home price, let's say we can time the market. If I can cash out at the peak of home price depreciation and then put that at private lending, is that a viable option? Or am I still losing the idea that this like cash flowing asset is something that I'll never be able to get again for another like generation, because we've just been through a historic, insane cycle?
It's a great question. Let's put some numbers to it. Okay. So we just talked about how a real estate cycle generally is lower than 4.3% or higher than 4.3% appreciation. It's not decreases. Generally speaking, that graph just showed that. So let's say that we have 8 to 10% home price appreciation this year. Okay. And who knows what happens in the future? I'm only going to predict 1 year out. So let's say that we have higher than normal home price appreciation for the next few years. At some point, if over a 10 or 20-year cycle, it's going to have to be lower than 4.3% is your point in order for the math to work. What do you think the lowest amount of home price appreciation, what number do you want to use? 1%, 2%?
I guess if we're gonna go with the assumption that we're gonna average 4.3 and we're gonna be at 8 to 9% for 3 years, then we're gonna need 6 years at 1%. I don't know. Like I'm trying to do the math. Like
yeah, it doesn't really work that way though. You don't know if that market cycle is going to be that 10 years. That's why we say between 10 to 20 year cycle, 10 to 20 years is a cycle. It's because not always at that 10-year point is it going to be back to that magic number. It might take 15 years. Like an example would be 2008. Well, let's say 2010 is really when the market bottomed. 2010 to 2000. No, I'm sorry. Let me go back. Market was at the peak in 2006. So 2006 to 2016, if you only took 10 years there, it's not going to appreciate at 4.3%. It's a little bit more than break even. So sometimes you need 10 years, sometimes you need 15 years, sometimes you need 20 years. So you're really sort of getting into this game. If you're thinking about this in your head, like You're like, well, if it's going to totally be back to this 4% number at 10 years, that's not really how it works. You don't know if it's going to be a 10-year cycle or a 15-year cycle or a 20-year cycle. But what we do know is if you go back and you do cross sections of those time frames over the years, that either 10, 15, or 20 years gets you back to that norm. Does that make sense?
Yeah. That part makes sense. So I guess then the question is, and I get what you're saying. Like what you're telling me is we're making these macro assumptions. If you take it in a snapshot, you could be way off, right? Like, so
that's exactly right.
Versus holding on to an asset that provides consistent cash flow, that is gonna, consistently pay down your loan for you, that, it's kind of set and forget. Like it is this idea of gambling on yourself after you've just created this like automatic cash machine. You're trying to like trade it up. I guess that's what I'm hearing.
Yes. We should not confuse this message and say that by looking at MOI or by looking at what pricing is relative to that 4.3% number, that we know what home price appreciation is going to be in 5 years or 6 years or 7 years or 3 years. We should not take it to that degree.
Yeah.
What we should use it for is to know that over a full market cycle, you should be around what the historical rate is and no more and no less too. We should factor that into our decision, but we can't take it to that degree that you're taking it to just because it doesn't work that way.
Correct. It's like saying the median American income is X, but if you look at one American, they could make $300,000 a year or $20,000 a year, and it's a pick of the hat.
Yeah.
So, okay. So a couple of other kind of like math game questions for you, Greg. And I know I'm testing your calculus now.
Can I answer one more? Because I thought you had a really good question about private lending.
Oh yeah, please talk about private lending versus.
Yeah. So let's just say 2% appreciation at some point. If you're investing in a market like Jacksonville at 2, and if you knew it was going to appreciate at 2%, and if cash flows went away, what would my expected return on investment be compared to private lending? So if you got rid of the cash flow number, like now our returns are between 8 to 10, and that includes the net rental income, which is the positive cash flow, the tax savings, and the principal pay down. Now out of that, we'll call it about 5% of that is your positive rental income. So now I'm moving into the future here where it's break even. So now instead of that 10% coming from those 3 profit centers, now you've got 5% coming from those 3 profit centers. Okay. And now we're going to look at the other profit center, which is home price appreciation. We said it was going to appreciate at 2% for this year. Okay. Well, assuming that you use financing and you put 25% down, that's really an 8% return on investment from the appreciation. So if you combine that 8% from the home price appreciation and the 5% from all profit centers not named positive cash flow, you're still earning a 13% return on investment just from this asset. And what I've done for you is taken away positive rental income. And I've just shown you that the real estate market is producing it at a 2% home price appreciation rate. So we're going, well below we're testing this theory out. And you can see here that you're still able to earn a great return on investment, probably better than you'd be able to return in the stock market. And that kind of goes back to the original point that even when positive cash flows are taken away, people are going to look at this asset and they're going to think that it's a better value for them than what they can do in the stock market.
That makes sense. So what I'm hearing there is if you want to take advantage of leverage, this is always going to beat that investment. Like, cause in private lending, I got to put up to 50 grand to get 10% on 50 grand. Whereas in rental property investing, if you're financing it, now I can be taking out 25 grand to get, 13% because I'm gaining on that 150, 200.
Leverage is the secret sauce here for investing in rental properties. That's why I talk about it so much. I want to help people understand how to use debt to your advantage. The private lending thing that we're comparing it to is a 10% return that you can earn from private lending currently. Now that number could change. So you don't really know. And then I would go away from always and nevers. on private lending versus owning rental properties, it's just about what you value more. If you own the rental properties, you're going to value the upside. You're going to value the possibility for the market to go up 4% versus 2% or 8% or whatever. In private lending, you're going to value the stability. You're going to value the fact that you never have to get charged for a maintenance issue or a vacancy issue. You remove that risk. So it's more about what you value more. I think both will be compelling arguments at that time. But to your point, yeah, even in a market that appreciates at a lower rate, your expected return on investment would be higher for owning rental properties, even if we took positive cash flow away.
Got it. Okay. So a couple of other math exercises for you, Greg. You're welcome. Roger Evans asks, what investment price point, cost of home, is it not feasible to be in passive income if the interest rate goes up? I'm assuming this is going to be something where you're going to have to mess with rent price, price of home, and it kind of is going to look like renting a home in Jack's Beach or something else.
Yeah, you could kind of mess around with this. Actually, this is a great time to talk about the ROI calculator that we offer. And Roger's a current client. And so Roger, if you'd like, just reach out to your portfolio manager, or anybody can go to jwbpassiveguide.com and you can download our passive income guide. And then we also include our ROI calculator. And the reason that I bring that up is because you can play around with the math. You can put, property values going up 10% a year. Now, let's say that the purchase price for a house that you're thinking about right now is $200,000. Put that purchase price at $220,000 and see what your cash flows are. And then you'll probably want rents to go up. Maybe, 3 to 4% is historically what they've been going up. So maybe choose something along those lines. So increase the rent that way, and then change the interest rate to whatever you think it's going to be in a year from now. So you can kind of play around with it there. Where we are now is that if you get to purchase prices, somewhere around 240, maybe 250 here in Jacksonville, you just typically can't make the numbers work. That's why the purchase prices for JWB properties are below those. That's because that's where we can get positive cash flow. But, though that answer that you're looking for is highly dependent on all three of those factors.
Cool. And Lee has a question that asks, has that home price appreciation been consistent even in the lower than average medium income for markets that JWB invests in? So for neighborhoods, really not markets, but has that home price appreciation stuck consistent within those sectors as well?
No, but it's the opposite of what you guys are thinking. Home prices in the below middle income neighborhoods, and actually even low income neighborhoods, have risen higher as a percentage basis than the properties in the higher income neighborhoods, which is shocking. In fact, I was thinking about this prior to the show. We should show people this data because I bet it would blow people's minds. I said that the low income, not even where JWB invests, the low income neighborhoods have actually appreciated at a higher percentage rate than the high income neighborhoods. And then the neighborhoods that we invest in, which is below middle income, have appreciated higher as well. And so it's not what people think. People assume that you can only get higher than normal home price appreciation rates in the higher income neighborhoods, and that's just not the case.
Awesome. Lee just sent us a little wink privately saying that he wanted to get that out there, home run for JWB. Thank you, Lee. We appreciate you, buddy. Teeing us up for great statistics. So Greg, as we wrap up this call, what's the, we just played a lot of mind games, man. Like we just talked about the idea that the real estate market is not about ups and downs. It's about higher than average appreciation versus lower than average appreciation. But in general, it's always going to appreciate. We talked about the idea that in the short, medium term, we're looking at crazy appreciation, 8 to 10%. You called on this show. We're going to make a little segment about that to keep you honest. And we talked about the idea that this is the opportunity as it presents itself today it's a window in time. Like we are in a window in time where everybody is able to eat, and those that eat now, may not be able to eat in the future, but you guys are uniquely positioned to continue to service it in comparison to the rest of the industry. So where are we in the market cycle? Like what is the final prognosis of where we are with the market cycle? Is it as easy as saying buy rating, sell rating? Is it a bull bear? Like how do you want to kind of put a stamp on like what the snapshot of the market cycle is now that you've explained all this stuff?
Well, it's very clear that we are in a higher than normal home price appreciation phase for this market cycle. And when you capitalize on higher than normal home price appreciation, along with lower than normal price of debt, you can create an incredible amount of generational wealth. And the writing is on the wall, like the numbers. If you believe that prices are going to go up in the future, and you believe that interest rates at some point in the future are going to be higher than what they are today, it would be impossible for cash flows to not go down. You know what? I probably shouldn't say that. It would be possible, but generally speaking, rents are not going to rise at a rate that's higher than home prices. So if you're looking at this and you're thinking, what can I do today to maximize my wealth? It would be buying today. If you have a pile of money that you've sort of set aside for rental property, this is, I think, the biggest opportunity, because, we don't all have money that we can just kind of bring to the table and buy 10 rental houses. But for some of us, we have money in the stock market, or we have money that's sort of set aside, and we're saying, you know what, over the next 3 years, or over the next 5 years, I want to go ahead and I want to buy one house a year for the next 5 years. I hear this a lot. And you have the ability to do that today. It is very real to me that your money would be best served to take that same pile of money that you were planning on investing in rental properties and doing it now, and then stopping. This isn't about buying more houses than you had planned, but taking that amount of houses that you had planned to buy and doing it today, because your interest rates are going to go up in the future. We're seeing that home prices are going to go up in the future, and your 5 profit centers will be better today than they will 1 year from now, 2 years from now, 3 years from now.
I like it, man. I'm gonna reframe that in saying that, because the way that I think of it in asset classes. I think of it as I subscribe to this like black swan theory of investing, where I want 85% of my money to be somewhere that I think is going to be consistent, that isn't going to be very volatile. And then I want to gamble with 10 to 15% of it, like, and take moonshots. So I take this and I think, man, so it's time for me to get my butt in gear and make sure, and because there is now this snapshot where this asset class that happens to be long-term stable, cash flow positive, plus upside, plus I happen to know who to call at this point in time. I take this as, man, I need to get all my financial ducks in a row in 2021, and see exactly how much that I thought that I wanted to put in index funds and T-bills and now rental income properties that has come into the mix. I take it as it's time to really just get my ducks in an order and try to acquire as much of this under the current cash flowing conditions as possible.
Yeah.
Okay.
That's what we talk a lot about with current clients and with people who are just starting to invest with us. We map this entire process out, and it's really cool because we're able to take your goals and whatever it is that you want to accomplish, we're able to assign a dollar figure of income that you need to earn from that. And that helps us understand the number of houses you need to acquire. And then we map this out over the next 5 years, 10 years, whatever your horizon is. And then we take the extra step and we say, all right, well, what would your cash flow be if we bought twice as many today than we did in the previous scenario? If you had 5 houses over the next 5 years, you bought all 5 year one, what would your cash flow be? What would your home price appreciation be? And we factor in, what would rising interest rates do to this? What would home price appreciation do to this? And we're able to show how your cash flows go down over time, and the appreciation that, or the equity that you earn, goes down over time because you missed out on some of it. So that's really what it is. And we offer that for all potential clients that are out there that want to have a plan in place, whether you buy with us or not. I think everybody should have this plan in place. And for current clients, like you are minted, Pablo, as a brand new JWB client, it's something that we do and we review routinely and at least once a year, or whenever clients request it. So yeah, I'm with you, man. I think this is the time. I've been singing it from the rooftops for a long time here, and I've never been more loud about it than I am now. And it's because I believe in my heart it's the thing to share with our clients.